welcome everybody. Obviously, we have some returning members of the community, and we also have some new ones. So for the ones that are have already heard me say this, I apologize. But for the new people, this is passive cash flow for life for multifamily. And then it's also the virtual REI Academy for residential. In terms of how this started was specifically for multifamily, and then I'll let Jane and Sharon, when we get to that point, I'll kind of talk a little bit about how that came about. So the way that this came about is that Nicole has been in commercial real estate, specifically multifamily, single family, mobile home parks, and self-storage for 25, 26 years, something like that, has had amazing success, thousands of units across the United States. And she has a real desire to give back. And about 11 years ago, she started to teach, and she's incredibly good at it. And I had been doing flips and was looking for something else, and I took her class, and we ended up getting along. So now we ended up partnering. But she's just a wealth of information. And the whole idea behind Teaching Tuesdays is, yes, you know, the class that I took is now online. And if you haven't taken that, I very much encourage you to take it. It's a phenomenal class. It covers more than anything, any class I've ever taken for a multifamily, top to bottom. And relatively speaking, it's a bargain. But we ended up doing this kind of as a mix of two things. One is to bring attention to the course because we think it adds real value to people. And we've had a lot of successes with it with people in the community. And at the same time, just an opportunity to kind of give back, right? Once a week, we have our monthly meetups, which are live here in Maryland. But then the Teaching Tuesdays is something we decided to do online. And it's grown and grown and grown. We have a lot of people that have registered. What's nice about it is we usually get, you know, anywhere between 6 to 20 people. So it's a nice kind of cohesive group. People can like kind of unmute and ask questions and stuff like that. So it's been real successful. People seem to really like it. So in terms of today, Jerry Lotz is a good friend of ours. He does cost segregation. And for those of you that are already aware of it, you can obviously do it for multifamily and for single family. And for those of you that are not aware, Jerry's going to give you a presentation on how he can save quite a bit of tax money to put it kind of back in your pocket. So he's with a company called Cost Seg Energy Solutions. Their mission is to help owners and leaseholders of commercial, multifamily, and single family save money on their federal and state taxes through something called cost segregation. Jerry is a Baltimore native, and I don't know how many years we've known you, Jerry. We've known you for a long time. I went to Towson University for a business degree, 30 minutes in managerial positions in the sales industry. And today, Jerry's big push is really to kind of help others achieve financial success even more in the real estate world. So, Jerry, if you're okay with that, I'll go ahead and turn it over to you.
That was excellent, James. Thank you so much. And Nicole and James, thanks for the opportunity to be here with you tonight. We've done several of these live and virtual over the years. And want to welcome the audience. It's fantastic that the group is spreading out across the country. Pretty soon it'll be an international conglomerate. That's great. So you never know, right, Nicole?
Yeah, well, I'm not going to hold my breath on that one. I'm glad this is getting to be national, more national.
There you go.
You're the one that goes international, not me.
But anyway, I echo the same comments back to both you, James, and Nicole. You folks are super people, nice to work with. And when I first met you and attended one of the meetups, live meetups years ago, I was really taken back and impressed by your attitude and your demeanor to help people. And how do you be a good landlord, basically? And you approach this business with a heart, and I love that. So I'm excited to be here tonight. I get excited about what I do. As you can see, it's probably not the first job that I've ever had. So I spent a lot of time in medical sales. I always wanted to do something on my own. And about 7, 8 years ago or so, decided that the time was there to do it. I was fascinated when I first heard about this concept, cost segregation. And it's not for everybody, but certainly it's for a lot more people today than it was 7 or 8 years ago. I've heard it termed the eighth wonder of the world. So, what I'd like to do today is spend a little bit of time talking about cost segregation and a few other ancillary types of or complementary initiatives that help business owners to save some money. So again, just a little bit of background about me. I've spent my life in Maryland. I've traveled extensively when I was in medical sales. Had a passion to do something on my own. I'm married for 41 years or so. Of two older daughters that are one's in New York, one's local here. So it's been a great life, and I'm looking forward to continuing to learn more about what it is that I do and ancillary avenues to help spread the good news about saving money. So when I decided to go to work for myself, I thought, well, I'm not going to do this unless I can really find some companies to represent that I feel good about and can sleep at night knowing that they're always going to do the right thing. So we'll talk a little bit about some of these other initiatives. Captive insurance, you may have heard about. There's a plan called 50/50 to help reduce mortgage business debt. Basically, we just took a gentleman that had $3 million worth of business debt, mortgage debt spread over a 25-year term. So in 25 years, he'd have gone out of pocket for $4.3 million. We cut that term to 13 years. He's only going out of pocket for $2.4 million because today we're setting up a cash generating mechanism through the tax code that in 13 years will have enough tax savings, cash savings built up to be able to pay the remaining mortgage debt. We do some things to help students that are burdened with student loan debt. There's some things to help people once they get to that retirement age and have to start take minimum distributions to cut their tax burden by about 75%, and some things in everyday expenses, a little bit in the energy efficiency sector. So, but for today's topics, the big concentration is cost segregation and what it is. Why do you do it? When does it make sense to engage? What if you've owned a property for a number of years? So there are a number of misconceptions out there about what's the right time to do this. Is it too expensive? What does it cost? And then we'll talk a little bit about some of those other initiatives. So I am really blessed to have found cost segregation services out of Baton Rouge, Louisiana. They've been around about just over 20 years, an independently owned company. So we're not affiliated with a CPA firm. They've got an amazing culture, just salt of the earth people that are part of that company. They've done about 40,000 projects across the country. With every project we do comes a clause where we will defend any of the work that we've done should a client come under audit. And every once in a while, for different reasons, clients come under audit. I can honestly say that of all the projects we've done and of the handful or so of clients that have come under audit, the IRS has never overturned any of the work that we've done on behalf of a client. We pride ourselves on doing a full, what's called an engineering-based study. And the IRS really terms that engineering-based study as the most certain method for applying the rules of depreciation. Once we have the calculations from a study, we look at the tax code and the different areas of it that we can apply these calculations to maximize the deductions. So really, what is cost segregation? It's the process of analyzing and identifying residential, rental, multifamily, and commercial building components eligible for accelerated depreciation. So why let the IRS hold your money any longer than they absolutely have to? I love this example. James and Nicole probably are tired of seeing me have this on the screen, but it hits home so much that I'll probably never get rid of it. So when I think of cost segregation, you think of the old jingle that McDonald's made famous with their Big Mac. For those of us old enough to remember that, it was 2 all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun, with some nice music behind it, and it's kind of stuck with me for 40 some years or whatever. So if you look at that Big Mac as its entirety, it's really a hamburger. But when you break it down into its components, you've got a list of 6 or 7 different components. If you look at that hamburger that costs $4, you've got to assume that each of those components that make up that hamburger have a cost associated with it. So the beef patties might be $2.20. The sauce may be 16 cents. The lettuce, another 14 cents. Pickles, 20 cents, or whatever, until all those costs add up to the cost of that hamburger. So if you think of a hamburger, think of a single building entity. Then when you think of applying cost segregation to that building, think of applying a cost to, or a value to, all the assets that make up that building. So the IRS says you can depreciate properties in 2 ways. For residential rental properties, it's a 27.5 timeline for depreciation. For commercial properties, it's a 39-year timeline depreciation. But they also have other categories called the 5-year asset class, 7 and 15-year asset class. So this chart kind of gives you an idea of some of the things that, according to the tax code, can be reclassified or put into a 5 or 7 year, and some of the things that can go into a 15-year class life. Even the lines on the parking lot have a value and can be reclassified into a shorter class life. So when you think of your own properties that you have, think of what type of decorative elements are in there. Are there any ceiling fans? What is the floor carpeted, or is it a wooden laminate? Are there countertops, window treatments? Is there some nice landscaping out there? Does it have a fence? All those assets can be pulled out of the total building cost and depreciated more quickly. And as everybody knows, when the more income you make, the more deductions you're looking for to go against that income, so you pay way less in taxes. I often get asked, well, who qualifies or who can benefit? What kind of buildings can you do? Well, if I'd have been asked this question 7 or 8 years ago, I probably would have said, well, gosh, your property's got to be $1 million or more in order to be able to qualify. But today, that's not the case. Through experience and technology, we're actually providing value for clients that have residential rental properties, commercial buildings that are valued at $150,000 and above. Basically, any type of facility can be cost segregated. We've done anything from a $150,000 condo to $1 billion+ resort. Now, some of the buildings, like a manufacturer or a warehouse, for example, that's basically block walls and a concrete floor with an office space somewhere in the corner, that will not have inherently as many assets that can be carved out and depreciated more quickly as would maybe a luxury hotel with all the amenities that you could imagine. So the tax laws, the biggest change in tax laws really happened in 1986, and it took 28 years for the next biggest change in tax laws to happen in 2014, called the Tangible Property Regulations. So these are not an option. These are laws that Congress put together to help owners of commercial properties, residential rental properties, better determine how they would depreciate that property. Whoops, getting ahead of myself. Tax Cut and Jobs Act. Really, I like to think that this put cost segregation on steroids. And I'll talk about that a little bit. And then the CARES Act had a lot to do with commercial buildings in this QIP correction. Basically, it refers to interior improvements in commercial properties. Just a couple real quick examples here. So here is a self-storage facility. It's climate controlled. We were able to find enough deductions to fund that client $164,000 in tax savings, $324,000 condo, $30,000 in tax savings for the client, and the warehouse, over $5 million property that was combination office and warehouse, $312,000. This is another area that I like to talk about, and I refer to it as cash for trash, because when you make renovations in a property, after you've owned that and had it in service for one tax year, you can actually calculate the value of the assets that are thrown into the dumpster. So I want to talk about a little caveat behind that, and an additional tip. I get calls from a lot of folks that are, they'll buy a property in September and they'll immediately start renovating, gutting it, rehabbing it, or whatever, and put it into service before the end of the year. And that's a great strategy. But if there is an opportunity or a possibility, if you're buying that property in September or October, to hold off on those renovations until the next calendar year or the next tax year. So you buy it and put it into service in October as is, and then in January, you start making these massive renovations. There's an opportunity to pick up that extra savings based on what you've thrown into the dumpster. Now, certainly if you've got a 6-unit, building and a 3-story rickety fire escape, and you buy it in, 1st of September, common sense would tell you, and morally and ethically, you probably need to replace that fire escape just for safety purposes. So, all else goes out the window if it's a safety factor that's involved. But just kind of something to kind of keep in the back of your mind, because a lot of folks have said, gosh, if I'd have known there was going to be extra tax savings, I'd have waited a while before I did X, Y, or Z. There's something in the tangible property regulations called capital to expense reversal. So the tangible property regulations came out in 2014. Accountants and building owners who looked at a expenditure of money before that and properly attributed it to a capitalized expense were going in accordance with the tax law. When the tax laws changed, some of those same efforts of work or effort expenditures that they properly attributed before 2014, now, according to the tax law, were able to be changed and could be expensed. So we take a deep dive into properties that have been placed in service prior to 2014 to look for opportunities where we can change things that were capitalized and automatically, immediately expense them. Tax Cut and Jobs Act. I mentioned I'd like to think of it as putting cost segregation on steroids. And really, we talked about the 5, 7, and 15-year assets. And before properties that were placed in service before 2017, September 27th, got that 5, 7, and 15-year accelerated depreciation. But any property that was bought and placed in service after September 17th now qualified on the 5, 7, and 15-year for 100% bonus depreciation. That's huge. You'll see an example in a slide that I have what of a dramatic impact that makes. So if any of you out there have a property that you put into service after September 27th, and before the end of last year, so, September 27th, 2017, December 31st, 2022, even if we did that study today, we could still apply those assets because you bought it during that time. We could still apply 100% bonus depreciation to the assets that we could reclassify into less than a 20-year class life. So here's an example of a project that we did before the Tax Cut and Jobs Act, 2017. Building cost $2.2 million. Multifamily, straight line depreciated over 27.5-year timeline. So we were able to, using straight line depreciation, that client, we would be able to find an increase in depreciation expense of $64,000 of assets that we could accelerate based on the old tax law. You take that same building and put it under the confines of the new tax law, and look at that increase in accumulated depreciation expense is now $500,000, earning that client a tax savings of $188,000. So before tax law, $25,000 in extra tax savings or $188,000. So that's why I like to think of that Tax Cut and Jobs Act really being cost segregation on steroids. Here's another property that I've used to give you an example of how we place values on the assets that make up that property. And a lot of those assets can be reclassified 5, 7, or 15 years. In this particular property, there's a number of 5-year assets, the cabinets, moldings, the wood flooring in this 6-unit had a value of $36,000. Mailboxes, entry canopies, appliances. There was a fair amount of exterior concrete work, some fencing for another $6,000 or so. So out of this $668,000 property, we found roughly $142,000 that could be accelerated for the client, saving them, oh gosh, I guess $140,000 probably would have saved them $40,000 or so in taxes. So within that same study, $668,000, we place values on what are called the integral building systems. So building components, building systems. So the doors and the frames had a value of $20,000, $25,000. The plumbing system, $67,000. So this is the value of those systems today. And then if you had to go and replace those today. So $668,000 today, if you had to spend money to replace it, $1,628,000. But these replacement costs really become pivotal calculations for when you and your accountant are making determinations whether something can be expensed or if you have to capitalize it. So there are a number of safe harbors that are in place for making those kinds of determinations as well for expenditures of $2,500 or less. But if you're looking at some of these bigger building systems, you've got a $244,000 electrical system to replace as a replacement cost. The IRS has roughly a 1/3 benchmark rule. They say if you're spending less than a third or so of the current replacement cost value in a single year, it's okay, you can expense that. But if your expenditure is going to be over a third, you better look at making that a capitalization item in your tax return. And naturally, all of us would rather expense it the first year and get the benefit of the write-off than having to write it off over 27.5 years. So $244,000, the client goes and spends $60,000 on electrical renovation. So $60,000 is well under that 1/3 benchmark, so they can expense that. They spend $100,000, it's over that third, so they better consider capitalizing that over the long term. This slide just has another example of the discussion that we just had. So, of course, the recording will be available and you can take a deeper dive into the slides. But This is another similar property, $1,012,000. The breakdown of 5-year. There was no 15-year in this property. This may have been a condo with no allocation towards any of the parking lot. So, but in 5-year alone, we found 20% of it, or 209,000, that could be written off in year one. And here's probably one of my favorite to share. That's that single family, no, townhouse rental actually in Bel Air, Maryland. So I did this study. The client paid $230,000 for the property. So you back out the land value of $50,000 and the building's $180,000. Found a lot of 5-year property that was in there. You know, it was adequately landscaped, sidewalks, nice exterior fence. So 130, let's see, 32,000 plus 5, so $37,000 worth of assets that could be written off in year one, saving that particular client about $13,000 in tax expense. So he got to keep $13,000 in his pocket instead of letting the IRS grab it. Here's the breakout of, again, today's building systems cost versus the cost to replace it. So now these costs to replace, he and his accountant can sit down and really make some bona fide decisions using these guidelines that will help them stay within the confines of the tax code, whether they're going to expense something or if they've got to capitalize it. So with cost segregation, there's some misconceptions around it. People think, well, gosh, I can only do this after I purchased a property. No, that's not true. In fact, a large number of our clients come to us who have owned it for 2, 3, 5, 10 years, some even longer. My building is not worth enough. As I mentioned, you know, early on, years ago, most companies wouldn't touch a property under $1 million. And today, even today, a lot of companies won't touch a property for under 300,000 or 400,000, but we'll actually do a lot of rental properties at 150,000. So it's too costly. Again, that's not necessarily true. 10 years ago, it was true because it was reserved for the mega $1 million buildings, the mega $1 million complexes, and the costs were very expensive to do this, $20,000, $30,000, $40,000. A lot of folks think, well, doesn't my CPA already do this? CPAs are, you know, they're great at their job. They know that the tax code's about 80,000 pages long. They know the tax code about a half an inch deep and across those 80,000 pages. But thank God there are a number of them out there today that realize that there are specialists they can call that know their portion of that tax code an inch wide and a mile deep. And we like to think of ourselves as knowing our cost segregation portion of that tax code, which is only about an inch wide, but it's a mile deep. If I do this, I could trigger an audit. A study in and of itself will not necessarily trigger an audit. Usually there's something else that comes out of the closet that, you know, flags the IRS for whatever reason. As I mentioned, if there's an audit that does happen for a client that we've done work for, we will do the additional backup work and defend the work that we've done on behalf of a client. If I've been treating a property using a straight line depreciation for a number of years and I go back and do a cost segregation study, do I have to amend all those past year tax returns? Not the case. There's just a matter of filing what's called a 3115 form with the IRS, telling them, putting them on alert that you're changing the method of accounting. And then there's an adjustment called a 481A adjustment that will pick up that catch-up depreciation that was not taken. If you sell the building, you're going to have to give it all back. Well, quite honestly, you'll have to give some of it back. But the value of having that money in your hands today, as opposed to letting the IRS hold on to it, what can you do with the money today? So you say, well, why should I do a cost segregation study? First off, this engineering-based method to put values on the components that make up that property really deliver the most accurate calculations of asset breakdown that you can use for depreciation purposes. It does have a heck of an acceleration benefit to increase the cash flow, sets up the framework for decision making for future cash investments. We're talking about those building values, replacement cost values. Well, without the framework of those calculations, you're really shooting in the dark. And having that framework, it helps the owner and the tax professional to really be at a total level of compliance within the tax code. When does it make sense to engage a study? Well, first off, the best time to do it is when you just purchase or improve a property. You've not filed a tax return on that property in the past. It's really the least expensive time for you to spend money to do a study. And certainly when the building or the improvements that you're making are $150,000 or more, then it's a good idea to look at least getting an estimate to see if it's worth paying for a study. If you've owned the property for a number of years, it could still be worth it. I'll never turn down an opportunity to run some estimates for clients. I just, right before this call, got a note from a CPA with a depreciation schedule. Client bought a building in 2008. Along the way, they made $100,000 worth of improvements here, 30,000, 40,000. All, even though the original building was back in 2008, I'll bet you when we run those calculations, it'll still be advantageous for them to pursue a study. So at a time when it doesn't make sense necessarily to do a study, first off, if you don't have any income that you're looking to offset, then you may not necessarily need to do a study. And certainly if you're thinking about selling that property in a year or 2 years, maybe even 3 years, because the return on it, you're going to have to give some of it back. And a lot of people just say, well, the juice really isn't worth the squeeze if you're going to fix and flip it or sell it within the next couple of years. So what does it cost and what's the process that's involved? Certainly an introductory discussion about the property, get on the phone with an expert to talk about what it is that you've got, and let them, assist in counseling whether or not it's worth preparing an estimate. So we would, prepare an estimate of tax savings and the cost for us to do that property. There's an engagement letter that comes with that the client signs off on. And then there's a deposit. And once we've got the engagement letter and the deposit, the client sends all of the building documents. Maybe it's an appraisal, architectural drawings, construction documents. Maybe there was a site survey for, a home inspection or whatever that was done. That all goes to home office, to our engineers and analysts. Somebody goes to that property and does a physical site visit. I love to do those myself if it is at all possible. I did 3 site visits today, one in Odenton, one in Pasadena, and Glen Burnie. And these were residential rental properties. It's a good opportunity to meet the tenants that live there and oftentimes meet the owner and find out little tidbits about the property that never would have come up had I not asked certain questions. So I love to do that. It gets me intimately familiar with the property so that if our engineers come back with a question about something, I'm in a better position to answer that. Now we service clients across the country. So certainly if you had a property that was located in California, one of our other representatives would go on site to actually take those photographs. So once all the information, pictures, documents are gathered, then we have what's called a complete package, and that project goes to the engineering phase. In the engineering phase, it typically takes 4 to 6 weeks because it moves through multiple teams of engineers. And just as a point of reference, the folks who prepare the estimates don't share those estimates with the engineers that actually do the studies. So they are truly doing a non-biased study, not based off of any predetermined estimated calculations. So it goes into one group of engineers that takes a review. The project moves to another group, and then finally a quality control group before the numbers are released. Once the numbers are released, we have a discussion with the client, the tax professional. Maybe there's a question that comes up or whatever. And then once we've determined that everything is all good, the client pays the final invoice and the tax professional has the calculations to apply to the return. So it's easy to start. If it's a property that's been owned for a number of years, a depreciation schedule is always a good thing to share, so we can better prepare an estimate and know what it is that's already been accounted for. Sometimes folks will come to us and say, look, I'm thinking about buying a property. Here's a real estate listing on the property. We can prepare an estimate from there. Other times they'll come to us and say, look, I'm thinking about buying this property. It's a 6-unit. It's going to cost me $700,000. We can actually prepare an estimate from there, because what we do, we match that information up against thousands of similar projects that we've done and come up with a benchmark of accelerated depreciation dollars and then a fixed cost for us to do the work. And I mentioned fixed cost because the work is not contingent, or the cost is not contingent on the amount of savings that we find. The IRS really frowns on that. So all of our projects have a fixed cost. So take a quick couple minutes and look at some of these other savings initiatives. Captive insurance, you may or may not have heard about it. Once companies grow to $1 million or more in revenue, they may want to set up their own insurance company, not to totally do away with other commercial insurances, but it's a way to provide extra protection against risks for themselves, a way to save on taxes, and actually they can use the funds that end up in that captive insurance company that they now own to invest in Wall Street funds to build wealth. So we end up setting these up for clients. We manage them, and the client takes advantage of the tax savings. The 50-50 flexible and free reverts back to that example where we cut that client's out-of-pocket expense on commercial debt from $4.4 million to $2.3 million and cut his term from 25 years down to 13 years. So anybody that's got $1 million or more in business or commercial or mortgage debt, we're happy to take a look and see if there's an opportunity there. We help them out with student loans debts. There's another initiative involving construction equipment, and it's the same bonus depreciation comes into play there. So I like to think of it as the Airbnb of the construction industry, where there's a site that's set up. The client makes an investment in construction equipment. We leverage that. They leverage it up with a loan to buy the equipment. They don't ever have to touch the equipment, don't have to maintain it, don't have to deploy it. There's a company that takes care of all that, and the owner of that equipment actually gets to see where that equipment's deployed, and they get the tax advantages. So this year, a number of folks are, they're investing $30,000 of their own money, leveraging it up to buy $300,000 worth of equipment. And on that $300,000 purchase, with the 80% bonus rules that are in effect, they've gotten an extra $240,000 worth of expense depreciation deductions that'll go and offset their income and even their W-2 income. So we can take a look at, everyday expenses. Maybe it's cable service, maybe it's cell phone service that clients are paying for, water cooler service, a lot of those types of expenses. And the idea is not to reinvent the wheel and change providers, but just to go back to that same provider on behalf of the client and say, hey, look, we know that through our experience, there's something better. There's a better program out there. They've been a loyal customer for 5 years. What can we do? Again, the thing about helping retirees, we do some things in energy saving. There's an initiative called Community Solar, where people who live in apartments, townhouses, single families homes can actually subscribe their electric meter to a local solar farm that produces electricity on their behalf. So there are no pieces of equipment, no wires special that get attached to their house. So this farm produces electricity that's sent to the electric grid. BG&E or Pepco draws the electricity, funnels it back to the house or apartment. And for that, the homeowner or apartment dweller actually saves about 10% on their electricity spend. For companies that have 5 or more W-2 employees, there's an initiative where they can say the owners can save on their FICA taxes while the employees receive some extra add-on health or wellness benefits. And the way it's set up at the end of the year, the employee's paycheck actually takes a slight bump up of about $1,000 throughout the year as well. So just a few extra tax saving, cost saving initiatives. I'm here to help. I hate to see anybody overpay in taxes or for any expenditure that they're spending money on. Thank you so much. Are there any questions that I can answer? I see there's a lot of things in the chat. I'm not seeing exactly what the chat is, but it looks like 11 entries have gone into there. So James, Nicole, anything that I can help with?
Most of the chats in here talking about where people are from and stuff like that in the very
Great,
beginning.
good.
I did have a comment. So I know that one of our members, Alex, bought and I always forget, Nicole, 22 or 32 unit apartment complex down in Southern Maryland and did a cost seg. And he saved like an enormous, I mean, I don't say it's like 400 grand. That may be, maybe I'm remembering that wrong or whatever it is, but he was like doing backflips on the amount of money that he was able to save on his taxes. So, so he's very happy. So we actually know people and we've done it ourselves. And Nicole, you've done it. You can save an enormous amount of money by doing something like this and take that money and then go buy something else and kind of keep flipping it, right?
So
Yeah, please,
I'm
Nicole,
sorry,
go
Jerry,
ahead.
go ahead. Go ahead and answer the question, Jerry.
So that's the idea. I mean, to put that money today in your pocket, and to be able to turn that around, reinvest it in your business, and you can, use it to pay down mortgage, buy more property, make improvements to properties that you have, or some people take a portion of it, just take a nice, well-deserved vacation too. So, yeah, Nicole.
Yeah, I had probably what's an unusual question. So, we have several manufactured housing communities.
Okay.
And in those, we have a number of mobile homes that the property actually owns those homes.
Okay.
So if you were going to, because with mobile home parks, most of it's land, right? I mean, you have some infrastructure and stuff, but most of it's land.
Sure.
But if you're owning some of those mobile home parks in that community, can they be part of a cost segregation study? And then you're really focusing on the homes, which are you depreciated kind of like cars.
Yeah. So our company, CSSI, has done a number of mobile home parks in its 20 some years of existence. There is value, there is return on investment in doing those mobile home parks. Me personally, I have not done a mobile home park, so I'm not as intimately familiar with the savings percentages that are involved there. But I know we've done a number of them across the company. So, and I'm sure they'll continue to do more.
My main focus is on if the park owns the homes, the mobile home itself. So
Right.
it's can those homes be part of that cost segregation study, or is it just the park itself?
No, the homes could be a portion of that. There's certainly some landscaping that's probably involving each of those homes that maybe the park as an entirety owns. So yeah.
I think Bruce has a question. Bruce, you can just
Yes.
unmute.
Yes. So we have our own opportunity zone fund, which we set up. We build single family rental houses. We use the cash from capital gains in the fund to build the houses. I'm being told we can't take advantage of cost seg without having debt on those properties. Can you address that at all?
It's a good question. So you don't have debt on those properties. So you're buying properties and you have no debt on them then, it sounds like.
Right, we bought land, we built the houses with the cash from the capital gains that we used to create the fund.
Sure.
I'm
Well-
being told that you have to have debt in order to take advantage of the cost seg.
Yeah.
Primarily because the IRS hasn't recognized that you.
I've honestly not heard that. I mean, if you buy a property, you're still going to be depreciating that, right?
I'm being told that because you do not have debt on it, that you can't use cost seg, or you very limited use of cost seg.
Yeah,
You don't have the gain, hasn't been recognized yet.
yeah. I honestly have not heard that. I will take a deeper dive with our VPs at home office. I'll make sure I get your contact information and follow up with you. You know,
Appreciate it.
yeah,
know,
absolutely.
I don't know nearly as much as Jerry by a long shot, but you know, if you own houses or things like that, and there is no debt on them, you are still taking depreciation across
Sure.
the years.
Right.
So you're still depreciating that property. And so I don't know, it would be illogical to me that you can't accelerate some of that. It may be there may be some tax nuances about how you can use that those tax savings, but I don't know why. I mean, we're still I have a lot of properties that are tax free, that are, you know, that are don't have debt on them right now, and they're still we're still depreciating them.
The issue appears to be the fact that the IRS does not recognize the cash as, because you haven't paid taxes on it. They're not saying you can play ball with that money in that fashion, that you have to have debt on the property in order to take the depreciation.
That I just don't, again, I have a pretty sophisticated accountants, and we have property without debt that are being depreciated. Now, it may be that you are doing something in a different way to not have debt, but you know, if you're buying something with cash money, you still depreciate that property.
Yeah.
I would, Bruce, I would check that out. I would let Jerry really check that out, but that just doesn't sound, it doesn't meet my best.
Yeah, the problem is finding someone who knows enough to answer the question.
Yeah, I'll be happy to dig deeper, Bruce. I just did a project for some folks that owned a business and sold that business and had, you know, $3 million worth of capital gains, and took that money and invest and paid cash for, you know, 4 or 5 different rental properties. And I just finished the studies on those. So their accountant must feel that there's value in doing that. So, but I'll double check with home office to see if there are any nuances, as Nicole mentioned. We learn something new every day for sure.
I appreciate it. Thank you.
Sure.
Jerry, Bruce put his email address in the chat, and I just copied and pasted it and sent it to you in an email.
Thank you very much. I appreciate that.
So I have another question then. So you talk about having to pay back some of the money you've taken if you do a cost segregation study and then you sell the property. is that also true if you 1031 exchange that property? Do you still have to pay that back? Or is that just kind of lumped in with the rest of the stuff?
Well, in a 1031 exchange, so if you have a property that is $500,000 and you sell it for 700,000, you've got $200,000 capital gain. If you invest that money into another property, then if you buy up, for example, then that will eliminate that tax exposure in that capital gain, basically.
I know, but I'm asking, that I knew, but what I'm asking is in relation to if you've done a cost segregation study and gotten $200,000 in tax benefit. So now you sell that property, but you're doing it under a 1031 exchange. Do you still have an obligation to pay some of that tax back, or is that lumped in with the rest of the stuff and kind of sent on down the line?
So the property, you're saying the property that you sold, you performed a study on?
Yeah, it's a hypothetical.
Sure, sure.
So
No, I
I
understand.
bought a property, did a cost segregation study, and 5 years down the road, and I made $200,000 in tax savings, right? Now,
Okay.
5 years down the road, I am 1031, I'm selling that property under a 1031 exchange, and all that money is going, into the exchange. Do I still have to pay some of that tax back from some of that money back from the original cost segregation study?
Yeah, yeah. I would think that it would. Nicole. That's a great question. I'm sure there are percentages involved that are way above my pay grade, but I will take that to home offices as well. That's a great
Okay.
question.
I'm just
They're going to
curious.
hate us.
No. Believe me, they are just a salt of the earth back in Baton Rouge. I can go to them with anything. It may take a day or two to get a response because they've just got so much going on, and more folks are actually more and more investors are actually contracting to do cost segregation. So our workload is exponential, which is a good thing. But they always get back to me. So, and if certainly if there's an opportunity to get on a 3 or 4 way call with somebody at home office and an investor or tax professional, we're always happy to do that with one of our VPs who's just a real tax guru.
So I'm wondering, and obviously you're the expert at this, Jerry, and your staff as well. So I guess I'm just curious if you're taking depreciation, then your cost basis is going down,
Cost
right?
basis goes down, yeah.
So when you go to do a 1031 exchange, your capital gain is now larger because you depreciated it. Therefore, I would think, and again, I am no expert, I would think
Sure.
that gain, even though it's bigger, you would not have to pay taxes on just because you did a 1031. However, to Nicole's point, maybe there's some other rule in there because it was cost segregation or accelerated or bonus, or I'm not really sure what the rules are, but to me, it kind of makes sense. You just flip it into another property.
Yeah, and it allows I see what you're saying. So it would allow the amount of gains that you've got to put towards another property to be larger.
Correct. Right.
Yeah.
And you still push that tax liability further down the road.
Further down the road, sure. Yeah.
And then you keep pushing it down the road until you die, and then your heirs kind of start your basis over again.
Yeah. Well, there's ways to minimize that tax exposure too. So but basically you're right. So yeah. So
at the end of the day, that's the goal, right? To pass it on.
Yeah. Yeah. To pass it along tax-free would be the ultimate, right?
Yep, exactly. Exactly right.
That's what IRAs are for.
Yes. What is the eighth wonder of the world, Nicole?
Roth IRAs.
Roth IRA. I got it.
Self-directed Roth IRAs.
It's funny because you had brought that up a couple of days ago, and I was talking to Isabella, my daughter, for those of you who don't know, that's 23 and just started the job. And she's very interested. So she's going to go ahead, now that she has earned income, she's going to go ahead and open one up and get started on that. So good advice. Any other questions from anyone? Trying to look at the 7:29, so we're about to float into the single family parts, which I guess you're going to be not redoing the whole thing, Jerry, but it sounds like you're going to address specifics on single families. Is that correct?
Well, yeah, I'm certainly going over the basics. Okay, if we've got some new folks that are coming on,
Okay.
and then talk a little bit again about the single family and some of those other saving strategies as well.
Okay, great. So I've got 7:30. Jane and Sharon, you want us to start the residential part?
I'm going to let Jerry get out of this one and put up the single family slides. How
Oh, okay.
about?
Yep. Sorry about
Flip
that.
side, sure.
Yeah, we
Okay.
need to, James, do you want to take this slide before we move to Jerry, please?
Sure. So as we talked about, the whole premise behind this and giving back and helping people was this course that Nicole teaches, which is about actually 60 hours worth of material. And it's funny because when I took the class the first time, it was like 12 hours a day, 4 days a week. And when we talked about putting it online, she was like, oh, good, because I don't have enough time during those 4 days to teach everything, which was mind-boggling to me because you'd walk out with kind of a glazed look on your face for so much information. So anyway, there's a couple of links here for you. The first one is actually a completely free webinar that Nicole talks a bunch of stuff about, and I'll put those links in the chat as well. But the first one was basically for a free webinar. It gives you 25% off the class. And even if you don't, end up purchasing the class, you'll get a ton of free information on markets and how to identify them and a bunch of other stuff. So I would strongly encourage you to do that. If you want to just go directly to our website, is passivecashflowforlife.com, and it really goes in detail into what is involved in the course. And then the one below that is the email address, which is support@passivecashflowforlife.com. That actually comes directly into my inbox, and I'm always good about returning emails within 24 to 48 hours. So whatever questions about multifamily, please feel free to reach out. If you're not a student, don't email me every day, but please feel free. We're very, very generous because I've learned that from Nicole in terms of giving back. So feel free to reach out. And then the bottom one is the YouTube channel, Multifamily Passive Cash Flow 138. And when you go to YouTube, all of these Teaching Tuesdays are actually on there. There must be, I don't know, 40 of them, I think, on there by now. And they talk all about different subjects that either Nicole has taught on. We've had guest speakers like Jerry talk about. I've talked about some, but there's a whole wealth of information, and it's all under one playlist, which is basically Teaching Tuesdays. So, and I will put all that stuff in the link so you don't have to worry about writing that down.
All right, I'll close this one and open the other one.
Yeah, please go ahead.
I think I can do this.
Let's see if I can find, there we go.
Where's that share button?
The bottom green button, I think it is.
Did that work?
It's on Google Slides. It's not on PowerPoint. I don't know if that makes a difference or not.
Okay, yeah, well, I'll
There you go.
better?
Yeah.
Yes.
Okay, super.
And I put all that information for everybody, all the links and everything into the chat. So feel free to click. And I would encourage you, if you're actually going to click on a link, to right click so it opens up in a separate tab so you don't lose this part. So if it works for you, Jerry, I'm not going to reintroduce you, but I will talk a little bit about the Academy and about Jane and Sharon. So what happened was several years ago, people had approached us and said, wow, multifamily is really fantastic. Do you guys have any classes on single family? And we're like, well, no, but maybe we can try and produce something to help people. So we rounded up about 15 full-time investors in different strategies of how they actually create wealth through single family. And it's not just rehabs, and it's not just wholesaling. There's a ton of different strategies you can do to create wealth in single family. So we created the virtual REI Academy. I think at this point, there's probably 55 courses on there, from everything to how to market for free, to how to do subject twos, to how to do notes, how to run a business. I mean, there's all sorts of information on there. There's a wealth of information. And Jane and Sharon are our partners. They're out of Sarasota, Florida. They are the experts in single family. They've done over 100. I never know what the number is, of over 150, 8,000. I don't know what the number is. I know it's a lot of them, and they've been super successful. So I will turn it over to Jane and Sharon.
Hey guys, thanks for joining in, and Jerry, thanks. Wow, this is a lot of good information for us too. I think I need to fire our accountant because I don't think they're doing any of this. But anyway, so thanks for being here. Again, like James said, we're just trying to give back and get the most current information and the most useful information. And obviously, Jerry's providing a lot of that this evening, and we're excited to hear how much money we can save on residential now that we kind of listen to the multifamily, excited about the residential. And with that, we'll turn it over to Jerry, and we appreciate you being here for us too and taking extra time.
Thank you, Jerry.
Absolutely. Absolutely. It's in the earlier presentation, I mentioned that years ago, this application of cost segregation was only available for through the big four accounting firms and the mega $1 million building complexes. It's exciting to be able to see average mom and pop investors like us that have got, that spend $100,000 on a property and put $30,000 or $40,000 into it, to be able to take advantage of this cost segregation application and to get a halfway decent return on their money that they're spending for the process. So I'm honored to be here. Before I forget, I certainly want to extend a happy and safe Thanksgiving and holiday season to everybody, and really appreciate the opportunity to work with James, Nicole, and now you, Jane and Sharon, tonight, along with the guests. Thank you. So, just a brief overview of me. Like a lot of you, I work for myself today. I didn't for a lot of years, and was always frustrated about having to go through 15 levels of management to get something done. And I thought I had a better mousetrap, but it wasn't in the long-term plan. I really enjoyed my time in medical sales, opportunities for travel, met some great folks, learned a lot, but always wanted to do something on my own. So it's, God has a funny way of working things out. It was just the right time in my life where my medical career was winding down. And if I didn't do this on my own at that point, I probably never would have done it. But I'm having a lot of fun at doing what I'm doing. Every day, something different. It gives me the flexibility to do what I need to do. My dad's 87 years old, and I spend a fair amount of time looking in on him and taking him to doctor's appointments, putting pills together. But thank God for the flexibility of, as long as I've got a computer and a telephone and a car, I can work almost any time. So when I decided to go to work for myself, I said, well, I'm not going to do it unless I can put together and feel good about the companies, a portfolio of companies that I represent, so that I can sleep at night, knowing that they're always going to do the right thing. So I ran across this concept of cost segregation, and couldn't believe something like that existed. And it actually kept me up at night wondering how in the world this existed. And I got all fired up about it. I hopped on a plane and made a trip to Baton Rouge, Louisiana, to the headquarters of the company that I represent. Spent an afternoon with the president and a couple of the vice presidents. and just it just felt like it was a match made in heaven. So um, in addition, so I started doing this cost segregation, and then through networking and other questions and needs that I came across, I put together a portfolio of a few other partners that I work with that provide some just amazing, unbelievable, deeper dives into the tax code with these little known initiatives that can help people and companies to save money. So we're going to talk about cost segregation. And I know some of this is repetitive from the last session, and I'll try and focus it more on the single family homes and the duplexes and things. And we are doing so many more of these types of properties today than we ever have in the past. So I really think that the Tax Cut and Jobs Act, which we will talk about, really put cost segregation on the map. When I first started doing what I'm doing, I set on my phone a Google alert for every time there'd be something that came out in the media regarding cost segregation. And I may have got a ding maybe once, twice every 2 weeks. And today, there's not a day goes by that there's not something published in a press release or whatever about cost segregation. So I think tax professionals are becoming more and more aware about it. We've seen tax professionals win clients because of their acceptance and ability to avail their client to cost segregation. And we've seen tax professionals lose clients because of their inability or lack of knowledge in the area. And clients decided, hey, I've just got to do something else. So we are tax professional agnostic. We will work with any tax professional. We spend a lot of our time coaching CPAs and enrolled agents up that may not be quite as familiar with the applications to allow them to best help their client. So we'll talk a little bit about when does it make sense to engage a study. There are a number of myths around cost segregation. One of the main ones being, well, if I buy a property and don't do cost segregation, can I go back and do it? They'll talk about the costs and the processes, and talk about a few other cost-saving initiatives. So again, I mentioned this company, CSSI. I pulled into the parking lot 8 years ago. My cell phone rings, and it's Jim Shreve, the president of the company, who I had no intention of meeting with that day. I was supposed to meet with one of his VPs. So Jim calls me. It's 1 o'clock in the afternoon. I got up, took an early flight to New Orleans, drove to Baton Rouge, and I'm in the parking lot about 1:45. Jim calls me and says, well, I guess you're almost here now. I'm in the parking lot. He said, well, I'll meet you at the door. So we went out and had lunch and had a great discussion. And I'm excited to say that it's just kind of been a match made in heaven. I really love their culture at the company. They'll do anything for me and for a client that I'm working with. So cost segregation, it's all about getting the money back in your pocket as opposed to letting the IRS hold it. So what do? You segregate the assets that are involved in a piece of property, whether it's a $120,000, $140,000, $50,000 townhouse up to $1 billion+ resort, cannabis farms, oil refineries. There are assets that make up that property that can be accelerated according to the tax code and depreciated more quickly, providing more cash flow. Love this example. I'll share it again briefly. A lot of us old enough to remember the Big Mac jingle of 2 all-beef patties, special sauce, lettuce, cheese, pickles, onions, etc. McDonald's made millions of dollars off of that. And I can honestly say that just about every presentation that I do that I incorporate this on, somebody will come back years later and say, I remember you talked about the Big Mac. So I'm not going to stop using this analogy, but if you look at a Big Mac, it's really just a hamburger. but it is broken down into integral parts that make it taste as good as it tastes. So that hamburger might be worth $4, but those beef patties are $2.25. The special sauce might be 16 cents, lettuce another 14 cents, cheese 70 cents, until all those components make up that $4 hamburger. So you look at a building the same way. The building's $150,000, but inside that building, there's walls, there's the sinks, there's bathtubs, there are sprinkler systems, countertops. There's a washer and dryer, maybe some special plumbing that's used to allow that to work. So all of those assets can have values placed on them, and a number of those assets can be pulled out of the longer term depreciation life cycle and depreciated in either 5, 7, or 15 years. I like to use this chart too because it kind of breaks down and gives a good overview of some of the assets that can be broken out into 5, 7, and 15 years. And another comment that always seems to ring home when I talk about even the lines that are on a parking lot have a value that's placed on them, and they can be put into a 15-year category, and the depreciation on those lines accelerated. So who qualifies and who benefits? Years ago, probably 10 years ago, most companies would not touch a property for cost segregation that was under $1 million. Today, I'm thankful and blessed to be able to bring this to building owners that have properties, $150,000 or so. I just did today 3 site visits on properties, and the one was a couple $100,000, one was 300, one was about $180,000. Anything from a single family to a duplex. So we're out and about doing these across the country. Anything from that $1 billion+ resort down to that smaller $100,000, $150,000 or so townhouse. Now, some properties inherently, because of the way they're made up and because of the attributes that are in that property, will have more components that will qualify for accelerated depreciation. For example, a warehouse that's 30,000 square feet, that's block walls and steel girder ceilings, and a 5,000 square foot office will not have as many dollars in that property as may a auto dealership or a hotel or a nursing facility. So different properties have different can deliver more in the way of accelerated assets. The tax laws. Everything that we do today is governed by a series of tax laws. Reaganomics 1986 was probably the largest tax law change in a number of years. And until then, from 1986 to 2014, so 28 years later, there was another huge tax law change called the Tangible Property Regulation. So there have been a number of continuing education courses that we've put together for CPAs and enrolled agents, specifically dealing with these tangible property regulations, because they really set the framework for depreciation going forward, to be able to give tax professionals and building owners a guideline, if you will, for being able to determine what money expenditures have to be capitalized for the long term and which ones can just be written off in the same year that they're spent. The Tax Cut and Job Act, I often refer to it as cost segregation on steroids, and we'll talk about that in a little bit, but it really put cost segregation on the map. I mentioned 8 years or so when I started doing what I'm doing, I get maybe 1 or 2 Google alerts about some publication that was out there in media on cost segregation. When the Tax Cut and Jobs Act came into place, that's when those number of Google alerts started increasing. More tax professionals heard of cost segregation. More real estate investors heard of it. The costs to do projects came down, and the value of the projects that we were doing and other competitive companies were doing also was reduced. I mentioned, most companies wouldn't touch a project for $1 million. Nowadays, a lot of companies will do projects in the $300,000-$400,000 range, and there's significant tax benefit that's there. The CARES Act really has more of a bearing on commercial properties, and some of you may, also delve into commercial properties. There's something called QIP, Quality Improvement Property, that was clarified, the specifics of how that's treated tax-wise. Basically, it refers to interior improvements in a commercial property that has been placed in service. So not necessarily just placed in service by you who might be the current owner, but any property and any previous owner that had placed that property into service in a previous tax year, and you as the new owner come along in this commercial property and make some interior renovations, they've set a whole area of the tax law devoted to those renovations that you're making in the interior of that commercial property. Partial disposition, and cost segregation. So these are just a couple of examples of some projects that we've done. Here's a condo. So again, very much in line with somebody that buys a single family type of a rental condo, $324,000 building cost, found enough deductions to get that client $30,000 in tax savings. Commercial properties like these auto dealerships. So a lot of franchisee locations have to, in order to maintain their franchises, do cosmetic upgrades every 5 or 7 years. Hotels and auto dealerships are probably the two largest sectors that do this. Well, there's an advantage in when they do this in actually calculating a tax benefit on the assets that the construction crew threw into the dumpster. And that's called a disposition calculation, or we like to refer to it as a partial asset disposition. That caveat was also first introduced in the tangible property regulations of 2014. So in this case, the original building, we did a study on the building, found $134,000 in tax savings. The client threw away a number of assets that we were able to calculate the remaining tax life basis on those assets to give that client $53,000 more of additional tax savings. And then we calculated savings on the renovations. A lot of companies these days that own larger commercial buildings, for example, are doing these LED lighting retrofits. Contractors are great at taking the lights out, ballast out, throwing it into the dumpster, and putting the new property up in the ceiling. The client's happy, they're saving on their electric bill. They've got a much more aesthetically pleasing showroom or warehouse or whatever, but very few people go along and capture the value of those lights, ballasts, and wires that were thrown into the dumpster. So I always like to bring this up because I run across a lot of investors that will ask me, that'll say, look, I bought a property, and immediately after I bought it, I went and I gutted it and rehabbed it. And that's a great thing. Maybe that property needed to have that done today in order for safety reasons, or to just even bring it up to code and make it available to rent. But if there's an opportunity to buy a property and you've got a tenant in it, if you buy it and you're thinking about doing some renovations, if you've got a tenant in that property and you buy it in September, October, if you can wait till the next tax year before you start making those renovations, then there may be an opportunity to take advantage of that first partial asset disposition, where you're taking advantage of the assets that you've thrown into the dumpster. I used
Jerry,
2000.
can I interrupt here for just a sec?
Sure.
I don't understand why we're talking about having to wait. Is it just that you would have to wait another full year to get the tax benefits?
Yeah,
So
that's the
there,
only reason. That's the
okay,
only reason, Nicole. Yeah. So it's got to be in service in one tax for a tax year in order for that partial asset disposition to take effect.
okay. Is it have to be the full tax year? So it has to be
No,
so it just has to be part of that tax year.
yeah. So if you buy it in September and then you put it into service and January 15th you decide to take renovations, it was already in service in one other tax year. So now that you're waiting till the next tax year, you can recoup some of the benefit of what's gotten thrown into the dumpster.
All right. So how are rehabbers, people who, so I can see this if you're rehabbing and then keeping something as a rental, that
Right.
you can take the advantages from the stuff that you are throwing out, plus now you can also cost segregate the new take as acceleration. So you're actually getting sort of a double dip, right?
Yes.
Is there a way that people who are buying things, rehabbing something, and then plan to sell it, can they take that?
So if you buy something in September, for example, September this year, if you bought it in September this year and it was not occupied, you're and then you're spending money to rehab it, you're technically not going to put it into service until the following tax year. So the money that you're spending, if you're buying it let me back up a minute. If you buy it in September this year and you rehab it and put it into service in December this year, you can take advantage of the original purchase price that you bought it for and the renovations that you bought it for. But you can't take advantage of the assets that you threw into the dumpster. If
Okay.
you
If you sell it retail, now you're selling it retail. Somebody else owns the asset, right?
when do you
You
sell it? When are you selling it?
I'm just saying, what I'm trying to get here is and I'm not asking this question very well. Rehabbers tend to fall into two camps. One's the ones that are rehabbing for retail, and then they sell the property as soon as they can. And then the
Sure.
other crew is the people who rehab it and then keep it as a rental. So they're sitting on that asset. So my question is there cost segregation opportunities for that first group who are rehabbing and then selling it to somebody else?
Well, there is a opportunity there. It is limited though because you're buying a property, you're rehabbing it. So we're studying the original property plus what you've rehabbed. Then you sell it and you've got the capital gain and you've got the cost segregation benefit on the work that we did, but you're going to have to pay a certain amount of recapture on that cost segregation benefit that we calculated.
So would the play be to this isn't going to work for a lot of people, but to buy something, rehab it, and then hold it for a year or sell it on owner financing, but not give them the deed. And now you can use the cost segregation savings in that year and then sell it or 1031 exchange it.
So if you buy it in September and rehab it and
Okay, I am not focusing on timeline. I'm focusing on being able to not to capture some of the cost segregation benefits that that you are not having to do quite so much recapture if you use a different strategy other than selling it retail. So you're holding it for a year or so on an owner finance method. Do you understand what I'm, does that
I
make any
think so.
difference?
Yeah, I think so. So, it's when you if you do a study after you've bought it and rehabbed it, you'll get the tax savings benefit on, the new asset or the old asset plus the rehab improvements that you've made. But as soon as you sell that, there's
Yeah.
recapture that you're going to pay. If you're able to create some type of creative owner or a rent to own type of a scenario that extends out for a few years, that's another area where you potentially could still take advantage of, take more advantage of the cost segregation benefits.
Okay.
I guess
Thank
if,
you.
if anybody's got a specific scenario where, we'd be more than happy to address that. And if it's way above my pay grade, I will get one of our VPs on the phone in a, 3 or 4 way call to discuss some options for sure. Was there anything else, Nicole?
No, that was just, I was just trying to figure out how I can have my cake and eat it too.
Okay. Did I answer that question? Maybe not the way you wanted to hear the answer, but
Well, I'm just, yeah, there is a way. I just am gonna have to figure it out a little bit.
okay. The wheels are turning.
So here's a question for you. So one of the members has and Charlene, you're on. I hope you don't mind my sharing this with them, but I thought maybe it might help you out with your project. So she has a 6-unit that needs to be completely renovated, and it's probably going to cost, I don't know, $250 maybe to do the entire renovation. Would she be able to take that $250 next year and take part of it and accelerate the depreciation?
James, you broke up on the last piece. What was the last thing you?
Oh, I'm sorry. So on the 240 she drops on the reno, how much of that could she actually depreciate through cost segregation?
Depending on what it is, what type of renovations were done, I would guesstimate anywhere from, 45 to $70,000 of additional depreciation deductions.
And she would take that and write it off against her taxes and save that tax money, correct?
Potentially, yeah.
Okay. Wow. Awesome. Okay, great.
Yeah, but depending on the timing, if it's something that's happened this year, the bonus depreciation is 80% this year. If it happens next year, the bonus depreciation, according to the tax law, goes to 60%. There's some discussion about bringing it back to 100% like it was with the Tax Cut and Jobs Act, but it's not. It's not a passed law at this point yet.
Right. 60% is nothing to sneeze at. That's pretty good.
Yeah. So within the tax laws too, there's something called a capital to expense reversal. And I mentioned the Tax Cut and Jobs Act is tangible property regulations 2014, probably the biggest change in tax laws in a number of years. So part of that tangible property regulations included something called a capital to expense reversal section that allowed building owners to go back and things that they, from 2014 2005 or whatever up to 2014, things that they properly entered into their depreciation schedule as a capitalized expense at that time. Now these new laws can be applied to those same expenditures of money, and some of those expenditures can now, according to the new law, be expensed automatically. So we were able to oftentimes go back and find considerable savings in properties that new application has been applied to. I mentioned the Tax Cut and Job Act's kind of like putting cost segregation on steroids, because all those 5, 7, and 15-year assets that we talked about back here, that we found that we can find in buildings that were placed in service after September 27, 2017 through the end of last year, can now qualify for 100% bonus depreciation. So this year, it's 100% has moved to 80%, but that's still an unbelievable tax benefit. So just a brief example of $2.2 million building that we estimated before the Tax Cut and Jobs Act took into effect. We're able to find an increase in accumulated depreciation expense of $64,000 after the Tax Cut and Jobs Act, and applying the new bonus depreciation rules increase that accumulated depreciation to $500,000, saving that particular client $188,000, stroking a check to the IRS. So I'd really like to talk about what some of those final reports look like, and the breakdown about how our engineers and analysts come up with these asset calculations and place values on property that makes up buildings. So here was a 6-unit, a certain value, $17,000 placed on the appliances there. The cabinets and millwork, $21,000 of this $668,000 expense or building value was placed on these cabinets and millwork. So out of $668,000, almost 21% of it was allowed to be accelerated. In each study, when we placed the current depreciable cost on those assets and building systems, which is just a combination of those assets, we also place a replacement cost. Replacement costs become pivotal in benchmarking for decision making, whether future expenditures need to be capitalized or reversed. For example, in this electrical system, $244,000, as well as the rest of them, the IRS uses a third benchmark. So if you're spending more than a third to improve this electrical system, then you probably need to capitalize that expense. If you can keep that expense to less than a third of this replacement cost, then you're within the confines of the tax code to be able to just expense that outright in the first year. This was probably one of my favorite projects that I did. I've actually created the slide. I've created a PDF as a handout, and something that I email to a lot of clients that are considering doing a cost segregation study on a single townhouse that they bought. So this project was done for a real estate investor that owns some multifamily, but probably 60% of his portfolio is in single family rental properties. This townhouse was bought in, I think it was 2021, and which puts it under the confines of the Tax Cut and Jobs Act. Purchase price was $230,000. Always have to back out a land value. And the determination of the land values, whether it's for single family or for condominiums or for commercial properties, determining the land value can sometimes be a challenge. Oftentimes there's a tax assessment that has been established on a particular piece of property that gives a breakout between the building assessed value and the land assessed value. Sometimes those tax assessments can be appealed, if you look at it and say, wow, why are they only attributing 10% to the cost of the building? They're attributing 90% to the cost of the land. There are folks out there that can appeal and oftentimes, win a change with the county or local tax assessor's office to change that building asset allocation. Maybe it's using comps in the area, or maybe there's another means that they will utilize. But if a client ever gets audited, or if a building owner ever gets audited, and the IRS comes back and says, well, how did you come up with that determination of breakdown between land and building value? Then, there should be a good defendable way to be able to have that you've come up with that allocation. It's like when you were in grade school, the teacher says, well, how did you come up with that number? Show us your work. Well, I guess the most acceptable way, or the path of least resistance, is to use the asset allocation that's put out there by the local jurisdiction. If you really think that that's not quite fair, then you may want to make an appeal or come up with a alternative method that you feel can be defendable in the event you come under audit situation. So in this $180,000 property, that's a building value, we found almost 21% or so that can be accelerated. So in this particular case, the client was in a heavy tax bracket. We saved him a little over $13,000 in tax expense. Again, in this same, lower cost property, there are building systems, and then there is a replacement cost. Somebody had to replace the costs of this property today. Here's what really gets me and gets a lot of people, and it's all around the misconceptions about cost segregation. It's amazing. I probably spend 25 or so, maybe 30 days at tax conferences educating enrolled agents and CPAs about cost segregations. So that takes up a good bit of my time in the course of a year. And it's amazing the number of tax professionals and CPAs out there that still kind of just turn a blind eye to the whole application. If it ain't broke, don't fix it. And if you're working with a tax professional, we'll work with all kinds of tax professionals and coach them all up if they're not familiar with it. But I think it's in everybody's best interest to work with somebody who's agreeable and open to, the new applications like cost segregation that are out there for even modest investors like you and me. So they say, well, you can only do it after you purchase a property. Not true. There's often great savings that's involved in the properties that have been accounted for and owned for 1, 2, 3, 5, 10, even 15 years sometimes. The building's not worth enough. Years ago, that was true. And today we're, finding benefit in $150,000 properties. People say it's too costly. Well, that project that we did, I'll disclose something here. That project that we did on that single family or townhouse that was $180,000 cost the client about $2,350 for us to do the work that we did, the engineering based work. But that $2,350 is also a write-off. So after tax money, it cost him about $1,700. So it gives us $1,700, and we helped him save $13,000 some dollars. So that was, what is that, about a 7 or so return on investment. Doesn't their CPA already do this? CPAs fall into all types of classifications. There are ones out there that are darn good at picking off what we call some low-hanging fruit and really knowing the tax code and knowing a lot of those safe harbors that are involved in the tangible property regulations to be able to write off some everyday expenditures. And then there's others out there that, turn a blind eye to the whole process. But CPAs are not engineers. They don't typically have construction background. to be able to go and really, really do a deep dive and separate out a invoice for $30,000 worth of electrical components and know that $20,000 has to remain long-term. But hey, this $10,000 worth of expense can be written off in the first year that it was paid for. So that's what a cost segregation engineer does. They pick apart these types of expenditures to be able to properly allocate the assets. Will it trigger an audit if I do it? That's probably one of the biggest misconceptions that are out there. And usually that's not the case. Usually something else that comes creeping out of the closet of the client's tax return that will trigger an audit. If a client that we work with comes under audit situation, we'll defend that work that we've done at no additional cost for that client. And in the 40,000 or so projects that we've done across the country, we've never had the IRS overturn any of the work that we've done. So if I've had a property for a few years and then want to do a study on it, do I have to amend all those past tax returns? No, that's not the case. We have to notify the IRS that you're making a change in the method in which you're accounting for this, but you don't have to go back and amend the return. There's a one-time 3115 notification form, change of accounting form, and then there is a catch-up calculation called a 481A adjustment that we provide so the tax professional can apply to the returns so the client saves the money. If I sell the building, do I have to give it all back? You don't have to give it all back. You're going to have to probably give a portion of it back, but I like to explain it like this too, in a way. If you buy a building 1 year and take advantage of the cost segregation benefits and all that acceleration in your pocket today, it may be another tax year before you got to give that back. So that's almost like a 0% interest for that time period from the IRS. Why would I do this? So certainly you want to do it to accelerate the depreciation, to keep that money in your pocket. And to do an engineering-based study really puts you in the maximum, sets up the framework for you to be in compliance with the tax code, gives you the most accurate asset breakdown for depreciation purposes. So it really maximizes your depreciation and sets up that framework for compliance for future decision making. When does it make sense? You just purchase or improve a property. So the best time to do it is before you've ever filed a return on that property in a previous tax year. It's going to be least costly to do that. You don't have to worry about the expense involved in that 3115 form telling the IRS you're going to change that accounting method. So that's really the least costliest and most tax advantaged time to do the study is when you first buy that property or when you make a major improvement. If you have no taxable income, then you may wonder if it's of any benefit to do that property this year. You may want to wait till you've got the taxable income. Or you may just want to go ahead and do it and have those depreciation dollars available in your mind so that you know that you've already got, $80,000 worth of depreciation dollars to carry forward into next year, because you will not lose the deductions of depreciations that are calculated. You can carry it forward until you can use them up. If you'd owned the property a number of years, we talked about that. I'll never turn down an estimate to provide, an opportunity to provide a free estimate. We don't know what we don't know, and it's amazing what we can find in depreciation schedules, whether it's just accelerated depreciation, maybe there's opportunities for expense to from capital to expense reversal, and a number of other opportunities. So, if you got a single family home and you bought it this year and you put it into service this year, you've got a tenant this year, you decide to do a cost segregation study this year, 3 or 4 years down the road, you say, well, I just need to do something with this property. And maybe the tenant moves out for a few months, and you spend $150,000, $200,000 on a major rehab there. Maybe there's an opportunity to come back and do another study specifically on the renovation dollars that you spent there to create some additional tax savings on that money. You're going to sell it. Most clients typically do not engage a study if they're going to sell it in the same year that they bought it, a year, maybe 2 years. Some clients will wait even 3 years or longer to do it. But as I mentioned, if you buy it in one tax year and take the tax benefit in that tax year, sell it the next tax year, you've basically got the free use of that money for that whole year. So let's see. What's the process involved? We can prepare an estimate based off of just very, very limited information. Have a conversation. If it was a property that they've owned for a number of years, then we would want a depreciation schedule that would give us the best information to be able to prepare an estimate. If the client comes to us and says, okay, I'm thinking about buying this single family home. It's going to cost me, $200,000. The land value is roughly, $40,000. We've got $160,000. We can prepare an estimate from there. Once the client sees the estimate, there's an engagement letter that comes with it. They sign off on the engagement letter. Then the information gathering process starts. Any architectural drawings, appraisals that were done, building construction documents. Somebody physically needs to go to that property and take a site survey. And basically that's, a number of pictures inside and outside to further document that of the assets that are included in that property. If at all possible, I love to do that myself. I've traveled from Florida, and this past summer I was in Maine doing site surveys myself for particular clients, just because I enjoy doing that. The project in New England, it was the first time I'd worked with this investor. It had a number of properties. I wanted to make sure that I showed the initiative and was the first, did the study myself. If the engineers come back and asked a particular question, I've actually seen it myself. We can do projects across the country. If one of you had a project in, I don't know, Arizona, one of our other representatives probably would do that case study. Would do that site visit out there for documentation, but you and I and your tax professional certainly would quarterback that project. The engineering phase of the project is actually about 4 to 6 weeks because it moves through multiple phases, multiple crews of engineers. There's an initial crew that looks at it, and then a secondary crew, and then a quality control crew. And I brought this up last session, but it's an important thing to mention, that our team that does the estimates and engagement letters doesn't really communicate with the engineers. So the engineers don't ever really see what the estimate looks like in a particular property. So it's really a non-biased approach that we take. And we are an independent-based company, so there's no, we're not affiliated with any accounting firms. We're kind of agnostic when it comes to the accountants that we work with. It's so easy to start. A conversation, depreciation schedule, phone call. I'm thinking about buying this and putting it into service, December of 2023. We'll take that information, match it up against thousands of similar properties, come back with an estimate of savings. Some of these other cost tax savings initiatives, as you all grow your portfolios of property and have a number of assets that are out there generating $1 million or more worth of income, some of these other tax savings initiatives probably would be most appropriate to take a closer look at. We do some things with college student loan debt. So many folks that get out of school are just burdened. I mean, it's like they're strapped with this college student loan that they can't, they can't buy a house. And we can help eliminate that and create a platform that ends up building some wealth for them for long term. We can look at everyday savings on everyday expenditures and negotiate additional savings there potentially. If we can't find savings, there's no cost to do it, but at least we've taken a stab at it. Maybe 6 months later, there's another opportunity. As folks get older and they're looking at some longer term estate planning initiatives, there are opportunities out there to help them pay so much less in their income that they're going to receive in later years of life, instead of having to pay taxes on those required minimum distributions. There's opportunities in the energy sector to help clients save some money, both commercial and residential. And for a number of investors are growing their portfolios to where now they've got actual companies set up and they're doing property management. They've got, a half a dozen, 10, 20 employees, and we can help them to save money on their federal taxes and help the employees at the same time. So I always tell clients, whether a property is newly bought, newly built, even if it's been owned a number of years, there's likely an opportunity for some tax savings. Never hurts to get a free estimate. So thank you all so much for bearing with me again. For the folks who've heard this or a rendition of this for the second time, I so much appreciate the opportunity, and of course always enjoy working with James and Nicole and Jane and Sharon. Hopefully we can work together long term as well. Thank you.
Sounds great. We certainly learned a lot tonight. Wow.
Yeah, some things to consider and look forward to, I guess, making more savings.
Jerry, thanks so
Well,
much for taking the time. I know you're very busy with all the different cost segs and stuff like that you're doing. Your information obviously is on there. And I actually sent something to you and the guy from Florida. I put you both on an email and sent it out for you. And then obviously your information's on there. It's also on the email that we sent out. If you have an interest in the virtual REI Academy, I put all the information on there. Jane and Sharon did a phenomenal free webinar on different creative strategies that are available. So again, that's in the chat, and it's also on here on this slide. So I would very much encourage you to watch that. Lots of good stuff to learn. And then what else? Jane, Sharon, what else?
I just encourage everybody to watch that webinar. We're really starting to run into a lot of subject to and some creative ways to purchase real estate without cash and getting those low interest rates. So definitely a good thing to watch. And then go to virtualreiacademy.com, and there's some freebies on there as well. And just take a look around. We have a lot of classes on there that would be very helpful in this in the single family space.
Jane and Sharon, what are you seeing as far as the folks you're working with that are investing in Airbnbs?
The Airbnbs seem to be taking a little bit of a dive. So
Okay.
they're not sustaining like they are. In Florida, it's a little different market down here. They flourish during these 3-4 months of snowbird season, but
Sure.
we know a couple people that really took a hit the rest of the year, and they didn't really plan for that. So
Okay.
they had a great January, February, and March, and now they're kind of scrambling. So,
Okay.
and we're hearing that across the US.
And then a lot of cities are just doing away with Airbnbs or making a lot of stringent laws and regulations to put in place where it costs a lot more for the homeowner to Airbnb it.
Yeah. I had that conversation last night with a client. They bought a Airbnb at a ski resort, and their homeowners association is up in arms about that. Yep.
Yeah, we knew one person that they really didn't say that they had them, and then all of a sudden the HOA came out and basically said you can't have it. So, and they didn't account for that, like when we look at things, we'll do the long term, and that'll be the max. And then if we do the Airbnb, that's just,
Added.
icing on the cake, so to speak. But if you plan your numbers on the Airbnb and you get slammed like that, so they took a hit on that house.
Right, right. As a company, we are doing a lot more Airbnb properties than we did 2 years ago. And there are a lot more, there's a lot more attention now that tax professionals are paying to clients who are wanting to get into that Airbnb initiative. So some of the Airbnbs we're seeing are folks that are buying more expensive upscale resort types of properties, Gulf Shores area, certainly Florida. But yeah, some of these some folks are, getting hurt, and some of the homeowner association regulations are bearing down too. So, yep.
No doubt.
And then they don't have an exit strategy for that house, and then they're stuck.
Right. Yeah.
Well,
They
then you
can't
buy it
vacation.
subject to- I'm sorry, go ahead.
No, go ahead, James, please.
I was just gonna say then Sharon and Jane pick it up at subject to, right? So.
Exactly.
Right on.
All right, well, listen, everybody, thank you so much for coming out tonight. We're right at 8:30. We want to be respectful of your time. Again, Jerry, thanks so much for taking time to spend with us and share this valuable information with us. And I would encourage you, if you have properties now, call Seg is a wonderful thing to reach out directly to Jerry. Otherwise, I hope everyone has a great night. And if I don't talk to you guys before then, have a wonderful Thanksgiving.
My thanks
Happy
to Jerry.
Thanksgiving.
Talk to you
Yeah.
Thank
later.
you all.
Thank you, Jerry. Appreciate
Thank
it.
you all.
Thank you.
Bye-bye.
Happy holiday.